Our next guest says she's staying away from U.S. Treasuries. Kathleen Gaffney is portfolio manager at the Loomis Sayles Bond Fund, which has about $160 billion in assets under management. She co-manages the firm's flagship Loomis Sayles Bond Fund and was awarded the 2009 Morningstar Fund Manager of the Year award in fixed income. And Kathleen joins us now from her firm in Boston. Kathleen, it's good to see you once again here on Fast Forward. You know, the last time we spoke, which was quite a while ago, you were very positive on Europe, and you were picking up European debt at deep discounts. Do you still hold on to those positions, and are you adding to them, given the sell-off we've seen on sovereign debt throughout the region?
We do still like what we're seeing in Europe, and you're right, it has been some time since we spoke. We've been buying for over a year now, and we continue to like what we see there. Yields are very attractive, particularly when you compare them to the very meager yields that we see here in the U.S.
Kathleen, I got to bring up the issue of Greek debt. We've talked about it so much on air, particularly in contrast to U.S. Treasuries. The two-year yield on Greek debt, you know, it's anywhere in the double digits. I think pick anywhere between the 60s and 80s, and it's been trading there. Do you like Greek debt at this point? I know it's a small percentage of your portfolio, but is that something you're willing to continue to bet on?
We continue to hold our Greek debt. We're not looking at those crazy yields at the short end in the 2-year. Where we're really focusing is at the long end, because what matters here is the discount to par. We think there's likely to be a restructuring. The market is very much pricing that in, and there's too much to lose if Greek exits the euro. So we think this is, yes, a good bet here.
I know there's been a lot of debate over the haircut that private investors should take on their Greek sovereign debt. Have you been involved in any of those conversations, and where do you see this really ending up?
We are aware of those conversations, although we have not been involved. We are looking at what the options are. There have been a lot of rumors flying around the market over the last several days, today in particular. One of those rumors is that there's going to need to be even larger haircuts. I think clearly where the bonds are trading, the long bonds in the low 40s, that is pricing in a significant haircut well above what the current exchange is on the table. So I think there's more to come in order to, and I think this is the important point, make sure that the debt load is sustainable. We don't want to keep going back to investors and asking for more. We want to get it done right.
And bringing it back here to the U.S., when I look at some of the things that you like in your portfolio and the composition of your portfolio, you don't like U.S. Treasuries. You do like high-yield bonds. You like convertibles. And, you know, currencies, when you look at currencies, you're sort of in a riskier area, Latin America and Asia, two countries that you like. Suggest to me that you think we're not, or the global economy is not heading into another recessionary period, and that maybe this is just a weak spell and we're going to come out of it just fine.
I do think that we're going to come out of it. I think it's going to be challenging because I think we're looking at low growth for a much longer period of time than investors are used to. But that actually is a good environment for fixed income, because if you're in bonds that you like the fundamentals for, you're going to collect those coupons, and that yield, having that carry right now, is oh so important when you're looking at very, again, meager yields in treasuries. And Latin America and Asia are a couple of ways to play that growth play.
In the U.S., in terms of credit quality, for a while there, it looked like corporate debt, whether we were talking investment grade or high yield, we saw some great returns over the last year, but just recently spreads have widened out quite a bit. Is that an opportunity from your perspective?
Whenever you see better values, that's a clear opportunity. Spreads, yes, have widened, but don't forget that corporate balance sheets are in very good shape. Corporations are sitting on a lot of cash. We'd like them to spend some of that cash, but as bondholders, that gives us a lot more confidence that we're going to get our money back. So the fundamentals are very positive, and there's some very attractive yields here. I think it is clearly an opportunity, but one where you want to focus on your issue selection. It's not a table-pounding time to be in high yield just to get that yield advantage, because growth is very low, and at the very low quality end, I think you have a risk of higher defaults. So picking the credits, thinking about the specific risks, the specific companies, is very important in this environment.
And just from a macro perspective, Kathleen, you know, portfolio managers, little fly here, by the way, portfolio managers, I know you're spending a lot of time analyzing everything. What are the biggest 3 events, or even the biggest 1 event that you're focused on right now? Is it over in Europe? Is it in Asia? Is it here in the U.S.?
It really is Europe. I think everybody knows what has to be done, but as every crisis that we've seen in the last several years, it all boils down to the politics, and that's going to make this a very difficult resolution, and I think that leaves the markets in a very volatile state. But in the midst of all that volatility, great opportunities for those investors who have the cash now and are willing to put it to work.
All right, Kathleen, appreciate your time. Always good to have you here on Fast Forward.